Hello everyone! Let's go into the Prometric updates and new tax law changes for businesses. So the Prometric EA exam cycle that we're currently in runs from May 1st, 2022 to February 28th, 2023. If you take your exam between those two dates, you're only going to be tested on 2021 tax law. As you can see down here at the bottom of this slide, this is directly from the Prometric EA exam bulletin. And it does state, in answering questions, candidates should not take into account any legislation or court decisions after December 31st, 2021. So that's what we're going to talk about. We're going to talk about tax law as it was passed, as it was, as of December 31st, 2021. And if Congress decides to pass any retroactive tax law changes later, then you don't have to worry about it. I'm recording these in March, so it's a done deal. Anything else that Congress decides to pass later on in the year is not going to be tested in this testing cycle. So everything that I'm going to be talking about is going to be tax year 2021 because that's the filing season that we're currently in. Now, I've already gone over the Prometric EA exam bulletin in the webinars for part 1, so I'm not going to rehash that here. If you haven't already watched that webinar, like for some reason you're taking part 2 first, or you just signed up with our study program for part 2, then I suggest you watch that webinar first before you watch this one, because I do go over most of what you need to know that's in the Prometric EA exam bulletin. For part 2, I do think you have to kind of have like a testing strategy. Part 2 is the most difficult part of the EA exam. It's the scope of part 2 is huge. There's so many different test topics. You have to know about so much different subject matter. As an exam strategy for part 2, I believe that you should go through all of the EA exam questions, all of the ones that you can go through, read them, take your best shot at the answer. Do not leave any questions unanswered because you'll get 0. But every single question is multiple choice. So even if you have no idea what the answer is, if you take a guess, then you have a 25% chance of getting it right. So don't leave any questions unanswered. If you have a question that forces you to do kind of a calculated math equation, in part 2, it's going to be more likely that you're going to have one of those than in the other 2 parts. Part 2, you might have to calculate the dividends received deduction. You might have to calculate the allowable charitable deduction for a C corporation that's made charitable gifts during the year. There's all sorts of calculations that you might have to do in part 2 that apply to business topics. If you do get a question like that, I think you should answer it if you have time. But I think the first time you run through the questions, you should just guess on those because you only have about 2 minutes for each question. So as a testing strategy, if you do have a question that forces you to do math, then I believe that you should guess and then come back to that question once you review the rest. Because some of the questions you won't have to do any math equations and there'll be questions that you'll already know the answer to. But what you don't want to do is run out of time. Okay, because you only have 3.5 hours. Part 2 is extremely difficult, and it's very likely that you'll use all of your exam time. All right, so do try to guess every single question. Do not leave it unanswered, even if you don't know, even if you have no idea what the answer might be. Just take a guess and then mark it for review. Come back to that question if you have time at the end, and you really have to watch the clock. So manage your time well. And whatever you do, don't get to the end with questions unanswered. Don't be like rushing at the very end. You have to manage your time. This is the exam breakdown that's listed in the most recent version of the Prometric EA exam bulletin. 30 questions are going to be on business entities. Business financial information is going to be 37 questions. And then specialized returns and taxpayers is going to be 18 questions. And then remember, you're going to have a portion of your exam questions that are going to be experimental and will not be graded. But you won't know which ones those are, so you have to answer every single one. You won't know which questions are experimental. Those questions won't be graded. The IRS is just basically testing those questions out. As you can see, the numbers here don't add up to 100, but there's going to be 100 questions on your test, but you have to answer them all. Okay, just realize that some of them are not going to be graded, some of those exam questions that you're going to receive, because they're going to be experimental questions. The exam specs for the new testing cycle for Part 1, Part 2, and Part 3 are listed on the PassKey website as well as the Prometric website. We have downloadable versions there, and here's the direct link to the page, and I'm going to show you where those are. The link in your slides there will take you to this page on the PassKey website. As you can see, here's the Prometric EA exam specs for Part 1 through 3. There's a track changes version, which the changes are in red in this version. And those are topics that have been added since the prior year, or topics that have changed. If I pull up the exam content outlines for Part 2, you can see here that these are changes that Prometric has made since the prior year, or the IRS: partnership cancellation of debt, partnership level audit opt-out. This is the CPAR, the centralized partnership audit regime, how to opt out of that, and we're going to talk about that. As you can see here, this section on rental property is new. It's just recently added to the test specs. But this information is all on the Prometric IRS website as well as on our website, and you can download it there. The one thing that I want you to see is that we actually have copies of prior year EA exam questions and answers. The IRS used to release complete exams back when the exam was not computerized. And then they stopped doing that, and then they started releasing them again in 2017, a smaller sample set of questions. But we have these on our website, and you can download this as a zip file. You can take a look at these older exams for reference. The answer sheet is there too. So there's complete exams. The older ones are complete exams, are 100 questions. And then the answer sheet is in there too if you want to take a look. Now let's go into the new tax law changes for business taxation for the current testing cycle. The information that I'm going to be discussing in this webinar is in the PassKey EA Review textbooks. They're available on the website, the PassKey online website, if you have a premium subscription, and then they're also available on Amazon and Barnes & Noble if you want a physical copy or a paperback copy. Let's talk about new tax law first. So there were 3 bills that are important to the 2021 tax year. The most important bill was the American Rescue Plan Act of 2021, which is ARPA. It was signed into law on March 11th, 2021 by President Biden. This bill included dozens of tax provisions that affect individuals and businesses in the 2021 tax year. Many of these changes also were retroactive to 2020, and there were lots of changes that happened mid-year that affected the 2021 tax year as well with this particular bill. The Build Back Better Act, or BBB as it's shortened, did not pass in 2021. There was a ton of press about it, but it did not pass. So the main bill that we're going to discuss in the webinars for this testing cycle is going to be the American Rescue Plan Act of 2021. The other tax bill that was passed in 2021 was the Infrastructure Investment and Jobs Act of 2021. It was signed on November 15th of 2021 by President Biden. Most of the provisions in this bill were not tax related, but there were a few business tax provisions included. This bill included provisions to extend the time for filing a petition with the U.S. Tax Court, and it expanded the definition of brokers to include businesses that regularly transfer digital assets, such as cryptocurrency. And then the last bill is the Consolidated Appropriations Act of 2021. This was signed into law on December 27th, 2020. So just right at the end of 2020. And this was signed by President Trump when he was still the president. This legislation extended and modified many provisions of the earlier CARES Act, which was passed in 2020. And a lot of these extender provisions also affect the 2021 tax year that were in the CAA 2021. Let's talk about filing deadlines. You have to know the filing deadlines for entities. You have to know when those tax returns are due. So the individual filing deadline was April 18th of 2022 this year for the 2021 filing season. And that's because there was a holiday in the District of Columbia. So Washington, D.C., there was a holiday called Emancipation Day. So it made it a tax holiday for everybody else. and April 18th, 2022 is the filing deadline. The extended due date is October 17th of 2022 this year because October 15th falls on a Saturday. So anytime you have a deadline, whether it's for a business or for an individual, if that deadline falls on a Saturday, Sunday, or a national holiday, then it gets pushed to the next business day. Estates and Trusts income tax return, we're talking about the Form 1041, that's a fiduciary income tax return, is due on April 18th of 2022. So it's the same original due date as for individuals, but the extension date is different. So the extension period is 5.5 months. It's not 6 months. So it's September 30th is the extended deadline for a calendar year fiduciary return. The estate tax return deadline, and we're talking about the Form 706, not the Form 1041. This is estate tax return for estate tax, is due within 9 months after the date of the decedent's death. We're going to talk about estates and trusts. Big long webinar for estates and trusts. It always takes me more than a week to record it because it's a very complicated subject. It's a very complicated subject, estates and trusts. But if it's a Form 706, there's no regular deadline like there is for other entities. If it's an estate tax return, which is the Form 706, it's due within 9 months after the date of the decedent's death. And there's a 6-month extension that's available. The partnership deadline for the Form 1065 is March 15th, 2022. If it's a fiscal year partnership, then it's the 15th day of the 3rd month after the end of the partnership's tax year, if it's a fiscal year filer. For me, personally, I think that it's just easier to remember the calendar year filing deadline rather than remembering, oh, is it the 3rd month or is it the 4th month or whatever. I feel like it's easier to remember the calendar year deadline. So partnerships and S-corps, they're due March 15th most of the time, right? So if you have a calendar year partnership or a calendar year S-corp, most of them are calendar year because partnerships and S-corps have a required tax year. And if you don't know what I'm talking about, if you don't know what any of this is, we're going to talk about all of it. But partnerships and S-corps generally have an unextended due date of March 15th. That's when those tax returns are due. And so that's the 15th day of the 3rd month. Commonly, the IRS on the exam, they will ask you, they will tell you it's a fiscal year partnership or a fiscal year C Corp. And I think it's just easier to count on your fingers. If you've memorized that it's March 15th, right, for partnership or an S Corp, and then they give you a fiscal year, then you just count from that date. So if it's a partnership, the normal deadline is December, right? That's the close of a calendar year, December, January, February, March, 3 months, right? And then they file on March 15th. If they give you a question on the exam and it's a fiscal year and they ask, when does this fiscal year entity have to file its tax return? And let's say they give you a partnership with a January year end, right? So instead of December, it's January and that's the end of their fiscal year. Then you would just count 3 months from January. So January, February, March, April, 3 months, right? So then that partnership would have to file its tax return by April 15th. And so on, right? So if it's a February 28th fiscal year ending, right? So the end of February, if that's when the fiscal year ends, then it's 3 months from February, March, April, May. And then they would have to file on May 15th. So that's how it works if it's a fiscal year entity. And in practice, most of the time what you're going to see is partnerships and S-corps that file on a calendar year. Most of the time, that's what you're going to see in actual practice. But if they're going to test you on something like that on the EA exam, they're probably going to ask you about a fiscal year because they want to make it a little more difficult, right? Okay. A C corporation deadline, so we're talking about Form 1120, and you do have to know these form numbers. 1120 is a C corp. It's due April 18th, 2022. So it's due the same day as individual tax returns, but this is if it's a calendar year C corporation. And to be honest, C corporations and exempt entities, most of the time, if it's a large C corporation or an exempt entity, they don't operate on a calendar year. Most of the time, they're fiscal year. But if it's a calendar year C corp, their filing deadline is the same as individuals, and their extended due date is the same as individual taxpayers. So for 2021 tax filings, the extended due date is going to be October 17th or the 15th day after the fourth month following the end of the corporation's tax year. If you have a C corporation that's on the fiscal year, then it's 4 months rather than 3 months, the way that it is with a partnership. The only oddity is C corporations that have a June 30th fiscal year end. Corporations with a June 30th fiscal year end, which is actually that's right in the middle of the year, right? So it's a really common fiscal year end, June 30th, like midway right through the middle of the year. June 30th, C corporations, their due date is the 15th day of the third month after the end of the entity's tax year. So for a June 30th fiscal year entity, the Form 1120 is due September 15th with an extended due date of April 15th of the following year. Many years ago, all C corporations had a due date that was the 15th day after the third month. And then Congress changed it a few years ago, but they didn't change the due date for C corporations with a June 30th fiscal year end. For whatever reason, these corporations retain their old deadline. And it's not permanent. This is going to change, I think, in 2025. There's a footnote in your book that discusses it, but this is just the oddity in the law. So as of right now, if you have a C corporation with a June 30th fiscal year end, then their due date is the 15th day of the third month after the end of the entity's tax year. So June 30th, right? That's right in the middle of the year, June, July, August, September, 3 months rather than 4 months like it is for every other C corporation. And the other thing that's odd about June 30th C corporations is that their extended due date is 7 months, not 6 months. So their original due date is September 15th, and their extended due date is April 15th of the following year. So 7 months from their original deadline. And they use the same extension form as other C corporations, but just if it's a June 30th fiscal year end corporation, then they have an odd deadline. They have an odd filing deadline and they have an odd extension deadline. Just remember that for the test. Then the S corporation deadline is March 15th, just like partnerships. The exempt entity deadline, so these are nonprofit groups, nonprofit organizations that file Form 990. Their deadline is May 15th for their Form 990, and their extended due date is November 15th. So May 15th is 5 months from the close of their fiscal year, if it's a calendar year entity. Employee benefit plans, these are retirement plans that have a filing requirement, like a 401k or a traditional pension. They have to file a tax return, an information return rather. It's the Form 5500, and I know that many of you have never even looked at this form. It's a specialization, and to be honest, most of you will probably never file one of these. I've only worked for a few practices in my career that have actually even filed these types of returns. Like I said, it's a specialization. These are due on the last day of the 7th calendar month after the end of the plan's tax year. So this is July 31st. Very odd filing deadline, folks. July 31st. If it's a calendar year plan, and an extension is available to October 15th for a calendar year plan. So it's an odd extension deadline and it's an odd due date. Okay. And then the FBAR, the official due date for the FBAR coincides with the federal tax return, which is normally April 15th. However, an automatic extension is allowed until October 15th. And I did put April 15th here because I want you to realize that the FBAR is not filed with the IRS. It's filed with the FinCEN, which is the Financial Crimes Enforcement Network. And I had Joel Bush, who's a CPA as well as a tax attorney, I had him double check this for me because even if the individual filing deadline with the IRS is April 18th and then the extended deadline is October 17th because it's a weekend or a holiday, officially to file the FBAR, it's still the April 15th and October 15th. The FinCEN and the IRS are two completely different branches, separate branches of the U.S. Treasury Department. The IRS is responsible for FBAR enforcement. If they're gonna assess penalties, it's the IRS that's gonna go after you. But the FBAR is actually filed with the FineCEN, which is the Financial Crimes Enforcement Network, and the due date is April 15th, and then there's an automatic extension allowed until October 15th. You don't have to file a form for the extension, but it's October 15th. So if it's a Sunday or a holiday or a Saturday, it's still October 15th. Okay? All right, officially. You need to know the estimated tax due dates for individuals and corporations. For individuals that have to pay quarterly estimated taxes, their estimated taxes are due April 15th, June 15th, September 15th, and January 15th of the following year. So April, June, September, and January. If it's a farmer or a fisherman, they get the option to pay either January 15th, just one lump sum payment, or if they're filing a tax return on or before March 1st, they can pay with their tax return on March 1st. So farmers and fishermen are the only ones that get to do that. And this rule only applies to self-employed farmers and fishermen. So if it's a partner in a partnership and the partnership is fishing activity or farming activity, then the partners themselves are eligible for these special due dates, or if it's a self-employed farmer that's filing on Schedule F. If it's a corporation that does farming as its primary activity, then the special rule doesn't apply to corporate farmers. So if it's a corporation that's doing farming and fishing activities, then the corporation has to use the estimated tax due dates that apply to every other corporation. So if it's a corporation, it's April 15th, June 15th, September 15th, and December 15th, not January. And this is if it's a calendar year corporation. But just remember, it's April, June, September, and December. This applies to any corporation that actually has to pay estimated tax. So most of the time we're talking about C Corps, right? Because S corporations are a pass-through and S corporations don't pay income tax most of the time. There are some times when an S corporation will be subject to income tax, and that's generally when they were a C corporation in the past and then they converted. So if it was a C corporation in the past and then it converted to an S corporation, then sometimes those S corporations will have to pay estimated tax. But if it is a corporation that has to pay estimated tax, whether it's an S corporation or a C corporation, then this is when their estimated taxes are due. April, June, September, and December, not January, like it is for individuals. FICA, payroll, and self-employment tax. So we're talking about Social Security and Medicare now, Social Security and Medicare taxes. For those of you who have any experience doing payroll, you understand that this is all the same tax, right? Social Security and Medicare. If you have an employer that hires an employee, the employer pays half of the Social Security and Medicare, and the employee pays the other half. If a person is self-employed, filing a Schedule C or a Schedule F, then they have to pay both halves of the Social Security and Medicare. They pay 15.3%. That's 12.4% for Social Security and 2.9% for the Medicare. There is a cap on Social Security in 2021. It's $142,800. Once a taxpayer makes above this in either wages or self-employment income, then they don't have to pay Social Security tax anymore. But for Medicare, there's no limit. There's no cap on the Medicare. So no matter how much you make, either in self-employment income or in wages, you're going to have to pay Medicare on the full amounts. Now, the additional Medicare tax affects employers. They don't have to pay it, right? So there's no employer share of the additional Medicare tax, but they are required to withhold it from an employee's wages. So if you have somebody working for your business, once they reach $200,000 in wages, then the employer is forced to start withholding additional Medicare tax at a rate of 0.9%. And then the FUTA tax is the federal unemployment tax. It's 6% on the first $7,000 of wages paid to each employee. and only the employer or the business pays the FUTA tax. The tax is not withheld from the employee's wages. So this is something that the business has to pay, whether it's a self-employed person that has employees or whether it's a corporation that has employees, they have to pay the FUTA tax if they hire anybody to work in the business. And the employer is the one that's responsible for paying that, not the employee. Estates and trusts. We're going to talk about estates and trusts. As I said, we have a big long webinar in the crossover videos folder that covers estates and trusts. The estate and trust exemption amounts for 2021 are $600 for an estate. A simple trust is $300. Complex trust is $100. And qualified disability trusts are $4,300. If you'll notice, this is the deemed exemption amount. This is the deemed exemption amount that applies to qualifying relatives. And this would have been the exemption amount that applied to individual taxpayers if the Tax Cuts and Jobs Act hadn't done away with exemptions. So the Tax Cuts and Jobs Act temporarily reduced the exemption amount to zero and doubled the standard deduction amount for individuals instead. So Tax Cuts and Jobs Act did away with personal exemptions, but then doubled the standard deduction amount so fewer people would have to itemize. That was the whole idea behind that tax law change. But the exemption for qualified disability trusts never went away. So QDTs, or qualified disability trusts, still get a personal exemption amount of $4,300. So that number is still important, folks. This is the number that's used as the income threshold for a qualifying relative, and it's also the exemption that qualified disability trusts get. And then other types of trusts, such as a simple trust or complex trust, they also get an exemption. The Tax Cuts and Jobs Act didn't do away with the exemption amounts for trusts and estates, but these are much lower. So if it's a complex trust, it's 100. If it's a simple trust, it's 300. And if it's an estate of a decedent, it's 600. The estate and gift tax exclusion amounts are right here. The estate and gift tax rate is 40%. That's the highest rate for the estate and gift tax. The estate tax exemption is $11,700,000. The lifetime gift or GST exemption is $11,700,000. These are tied together. They are linked. The gift tax annual exclusion is $15,000, which means you can give $15,000 in either cash or property to any one human person in a year, and that never has to be reported. So that's the annual exclusion. And then there's other excludable gifts as well. We're going to talk a little bit more about that later. The annual exclusion for gifts to a non-citizen spouse is $159,000. So you can give gifts to your spouse, basically unlimited gifts to your spouse. If I wanted to give my husband $1 million, I could do that, and that's not reportable anywhere. But if you have a spouse that is a non-citizen, and this includes if they're a green card holder, then the gifts are not unlimited to a non-citizen spouse. So it's one of the rare areas in the code where a green card holder is actually treated differently than a US citizen. And we're going to talk about that when we get to the chapter on estates. The NIT. So the net investment income tax, which we talked quite a bit about in part 1, usually affects individual taxpayers. And individual taxpayers do a lot of things to try to avoid getting hit with the NIT because it's 3.8%. It's kind of a big tax. It's a tax on net investment income over certain thresholds. The thresholds for individual taxpayers are much higher than this. The NIT affects estates and trusts at a much lower threshold. So an estate or a trust that has net investment income, if the estate or the trust decides not to distribute that income to the beneficiary, then the estate or the trust can be subject to the NIT, and it's a much lower threshold. Like I said, it's $13,050 in 2021. If the estate or the trust has net investment income over this threshold and doesn't distribute those amounts to the beneficiaries, and the tax rate is the same. So if it's an estate or a trust that gets hit with the NIT, the tax rate is going to be 3.8%. And this doesn't affect partnerships or C Corps, doesn't affect those types of entities, just estates, trusts, and humans, natural persons. The nanny tax. So we talked about the nanny tax in part one quite a bit, but the nanny tax is a tax that applies when you hire a household employee. So we're talking about this from the employer's perspective, right? Because we're talking about businesses in part two. That's what we're talking about here. But a household employer is still an employer. So if I hire a nanny to work in my home or a private chauffeur or something like that, any other type of household employee, then once I pay them more than $2,300 in wages in 2021, I am forced to withhold Social Security and Medicare tax from their wages. And I'm also required to pay FUTA tax, just like any other employer. And these thresholds are on a per employee basis. And I think you need to know this for the test. It's $2,300. That's the nanny tax threshold for household employers. 2021 Kyocera and FSA limits. So a Kyocera is a type of reimbursement arrangement that's available to very small employers. If you have a very small employer that is not subject to the ACA thresholds, it's not an applicable large employer, then they can set up a Kyocera for their employees where they reimburse the employees out of pocket premiums. Then the employees can go out and buy their own health insurance. If the employer does reimburse, though, there's caps on the amount that they can reimburse. If it's an employee only, it's a maximum of $5,300 for the employee in 2021. And if it's an employee plus family members, the cap is $10,700 for Kyocera. The FSA limits in 2021 changed, and this is just a temporary change that was implemented by the American Rescue Plan Act. So in 2021, if you have a business that has an FSA, which is a flexible spending arrangement, generally these are offered by large employers. So I had an FSA when I worked for the state of California. Very big businesses generally will offer FSAs because these are costly to administer. Okay. But if you have a business that has an FSA, the dependent care FSA limit in 2021 is $10,500. It was only $5,000 last year, and the American Rescue Plan Act just made a temporary change to these limits and allowed employers to increase it. But these provisions are optional, and employers were not required to adopt them. So many of them did not, because in order to adopt this kind of a change, this is just a temporary change. It's only for 1 year as of right now, unless Congress does something by the end of the year to extend it. This was just a temporary change for 2021. And in order to make this change, the employer had to draft a plan amendment. I don't know how many employers actually ended up doing this because, like I said, these provisions were optional and employers didn't have to increase these amounts if they didn't want to or if they found it too difficult to make these types of plan amendments. The healthcare FSA stayed the same. It's adjusted for inflation every single year. But what I'm saying is that ARPA didn't increase the dependent care FSA contribution limits for 2021. They did for the dependent care FSA. Congress changed this limit just for 1 year. But the healthcare FSA remained the same. It's 2,750. So it's just the normal increase for inflation. But this huge jump this is just temporary. It's usually $5,000 and it was increased to $10,500 in 2021. HSA limits. So this is not an FSA. This is a health savings accounts, and these are typically offered by small employers. So the FSA, generally large employers. HSA, generally offered by smaller employers. So an HSA is always offered with a high deductible health plan. You have to have both. These two always go together. So you have to have the HSA and the high deductible health plan in order for this to be a valid HSA. Here are the contribution limits for the year. I don't think you need to memorize these thresholds, but they're in your book. And we're going to talk more about HSAs and FSAs when we go over the chapter for fringe benefits. The Section 179 deduction. So 2021 maximum Section 179 expense is $1,050,000. The beginning phase-out limitation starts at $2,620,000. The spending cap is $3,670,000, and the heavy SUV limit in 2021 is $26,200. And we're going to go over what all of this means when I go over the chapter for depreciation. Bonus depreciation. So bonus depreciation is going to disappear pretty soon. The 100% bonus depreciation amount remains in effect through January 1st, 2023. So this is the last year, folks. Then it starts to phase down and eventually bonus depreciation is going to disappear unless Congress extends it, right? So bonus depreciation applies to new and used property. Assets that qualify for bonus include maker's property with a recovery period of 20 years or less, computer software, water utility property, land improvements. This would include something like fencing or like concrete walkways, that sort of thing. Qualified improvement property, qualified film or television production, but this does not include pornographic films. Qualified live theatrical productions as defined in section 181E, and fruit and nut bearing trees, if you're a farmer. The QBI deduction. So we're going to talk a lot more about the QBI deduction. We have a special webinar, a single webinar that's just dedicated to this deduction, but it's been a very popular business deduction. I don't know if Congress is going to extend it because a lot of businesses have been taking this deduction and lowering their taxable income by quite a bit. But the QBI deduction is a deduction of up to 20% of QBI from a pass-through entity conducting a trade or business in the U.S. It also includes up to 20% of qualified real estate investment trust dividends and qualified publicly traded partnership income. Certain limitations may reduce or eliminate the deduction amounts, and the Section 199A limitation phase-in ranges are as follows and are based on taxable income. These phase-in ranges apply when you have a business that is an SSTB, which is a specified service, trade, or business. And we're going to talk all about that in the dedicated webinar for the QBI deduction. Mileage rates. So the 2021 standard mileage rates are for business, it's 56 cents per mile. For charitable purposes, it's 14 cents per mile. And for medical and moving, it's 16 cents per mile. 2021 qualified transportation benefits. For commuter benefits or transit passes, it's $270 per month. And for parking, it's $270 per month. And if you have a business, the business could potentially provide both commuter benefits and parking to the same employee in the same month, and this would be a non-taxable fringe benefit. The big change that happened with qualified transportation benefits several years ago was that these are no longer deductible by the employer. So if it's a business that offers, for example, transit passes to the employees, then the fringe benefit itself is non-taxable to the employee, but it's not deductible by the employer anymore. So it becomes a non-deductible expense to the business. But the business can still offer transportation benefits tax-free to the employee. It's just not deductible to the business anymore. There are new partnership and S-Corp schedules that were introduced in 2021. These are the new schedules K2 and K3. So there's not just a schedule K1 anymore for partnerships and S-Corps. The schedules K2 and K3 are required by partnerships and S corporations that have international items, so items of international tax relevance. These are not on the test specs, just so you know. We've double checked. These forms aren't even ready for e-filing yet. The IRS has stated that the e-filing for the new Schedule K2 and K3 will not be available until the following dates: March 20th, 2022 for Form 1065, and mid-June for the 1120S. So way past the normal filing deadline. These are not even going to be available for e-filing until then. There's been a lot of confusion in the accounting community regarding these schedules because the guidance has been kind of coming out of the IRS in dribs and drabs really slowly, and accountants are begging basically for guidance on how to deal with these schedules. They're not even ready for e-filing. So they're really important. They're really important, but you're not going to be tested on them in this testing cycle. So we only cover them very briefly in the book, and I'm not going to talk about them because the IRS isn't going to ask you about these for this exam. Updated rules for meals. So in 2021, businesses, including self-employed taxpayers, can claim up to 100% of food or beverage expenses paid to restaurants. So it has to be specifically food and beverages that are purchased from a restaurant. It's okay if you get that food to go. It has to be a restaurant that prepares and sells food or beverages to retail customers, and it can be for immediate on-premises consumption or off-premises consumption. So, for example, if you take a client to go eat, right, or if you take your employees out to eat, then it's 100% deduction if you do it in a restaurant. And that's true whether you get the food to go or whether you eat it there. But the IRS did issue guidance on November 16th, 2021, kind of late in the year. It's notice number 2021-63. And they clarified that the 100% meal expense deduction also applies to the meal portion of a per diem rate or allowance. So if you have a business that's reimbursing employees using a per diem, then they can also take 100% of the per diem. But business meals purchased in any other setting or venue are still subject to the 50% limitation. So this would be if you were to go purchase a meal in a grocery store, for example, and it was a business meal, like maybe you go to a CPE webinar in another state or something, and you want to go purchase a meal and you go into a grocery store rather than a restaurant, then that meal is going to be subject to 50% limitation rather than 100. So it has to be a per diem meal, or it has to be a meal purchased from an actual restaurant. And I'm assuming any kind of restaurant qualifies, like fast food or a sit down restaurant, that's fine. But it can't be like a convenience store or a grocery store or something like that. So it has to be an actual restaurant. Net operating losses. I talked about this in the intro webinar for part 1. But you have to know the changes with net operating losses that apply to businesses. I think you might get a question about net operating losses on the EA exam in part 2. So if you have a net operating loss that arises in tax year 2021, the net operating loss actually occurs in 2021. Those net operating losses may only be carried forward with few exceptions. And then a net operating loss deduction that's carried forward cannot exceed more than 80% of taxable income. Losses generated prior to 2018 are not subject to the 80% limitation. And there's a detailed chart in your book. But if, for example, you had a business that had a huge loss, let's say that the business had a huge loss in 2017 or an earlier year, sometimes that'll happen. You'll have a business that has a huge loss and they're carrying losses forward. If the business has a loss that was actually generated prior to 2018, then the old rules apply to that loss, and that loss can actually offset 100% of the business income until basically it's used up. But if you have a loss that is generated in 2021, it has to be carried forward, number one. And then when it does get carried forward, it can only offset 80% of the business's taxable income, not any more than that. So basically, it can't take the taxable income down to zero anymore, like it could in the past. For most businesses, a net operating loss can be carried forward indefinitely until the loss is used up or the taxpayer dies. And, we're talking about a self-employed person in that case, because a corporation doesn't experience a death like a natural human would. But if you have a person who is self-employed, then they can continue to carry that net operating loss forward basically indefinitely throughout their life until they use it up. But if the loss occurred in 2021, it has to be carried forward and it can only offset up to 80% of taxable income in any future years. For pass-through entities such as partnerships and S corporations, the excess loss limit applies at the partner and the shareholder level. So the losses would get passed through if it's a partnership, for example, and then the loss limits would apply at the individual partner level. Now, there are 2 exceptions in the law. The first exception is for farmers. So if it's a non-corporate farming business, so not a corporation, folks, This is if it's a partnership, right? Or if it's a self-employed farmer. If it's a non-corporate farming business, they are allowed to carry back their losses for 2 years. They have a 2-year carryback. And this is the default. It is not the election. I verified that. So a farmer that does have a loss in 2021, the carryback is defaulted to 2 prior years. If the farmer doesn't want to carry back their losses and they just want to carry them forward, that's the election. So the default is the carryback, the election is to carry forward. So if the farmer does elect to waive the carryback period, the two-year carryback period in 2021, then it's irrevocable. They can't change their mind afterwards. It's an irrevocable election. If a farmer has both a farming loss and a non-farming loss, the losses have to be treated separately. So the farming loss is treated as a separate NOL and taken into account only after the non-farming NOL is applied. So for example, if you have a person who has a farming business but also owns another kind of business like a car wash or something like that, then you don't aggregate the losses together. The farming loss is considered separate from the other business loss. Okay, they have to be considered separately. So farming loss, 2-year carryback. They can waive the carryback, but if they do waive the carryback, then it's irrevocable. When you waive the carryback, that's an election. The 2-year carryback is the default. Okay, unlike every other business. So every other business, you have to carry it forward. That's your only option now. But if it's a farmer, then they have to carry it back unless they waive the carryback period. And that's an irrevocable election if they do that. Now, there's another exception for casualty insurance companies. You're probably not going to see very many of these, but casualty insurance companies are weird in more than one way. If it's a property and casualty insurance company, they are also allowed a 2-year carryback period for their NOLs, just like farmers are. They can also make the election to waive the carryback period. But what's weird about casualty insurance companies is that the NOL carry forward is limited to 20 years. They don't get an indefinite carry forward period. They can only carry their losses forward for 20 years. So there's a time limit on how long they can carry forward their losses. And then the 80% limitation doesn't apply. So unlike every other business, they have a 20-year carry forward period. It's not indefinite. And if they do carry their losses forward, it's 100%. They're allowed to claim 100% of their losses, but everybody else has to claim 80. Just these guys, just casualty insurance companies. So yeah, this is an oddity in the law. And then the last thing we're going to talk about on this slide is the changes for excess business loss limitations. So for 2021 through 2026, excess business losses of non-corporate taxpayers are subject to an annual limit of $262,000 for individual taxpayers and $524,000 for married taxpayers filing jointly. Excess losses over these amounts must be carried forward. Excess business losses that are disallowed are treated as a net operating loss carried forward to the following taxable year. And to be honest, I don't have any clients that have had losses exceeding this amount. So I haven't done a tax return yet where somebody had over $500,000 of excess business losses where it was a self-employed person, because this excess business loss limitation only applies to non-corporate taxpayers. So taxpayers that are not corporations. And usually if a business has this many losses, they're like going under quickly. But if it is a business that has more than $262,000 if it's an unmarried taxpayer and $524,000 in losses if it's married filing joint, then they can't claim more than this amount of losses, and any excess losses have to be carried forward into future years. And there's some examples in your book, but I don't think you're going to see this very often. This would be a situation where a business had a really catastrophic loss. The stalled e-file mandate for businesses. So the Taxpayer First Act of 2019 was passed on July 1st of 2019. And we've been talking about the Taxpayer First Act a lot because it affects the filing requirements for exempt entities and also the filing requirements for individual taxpayers as well as businesses that file information returns. And by information returns, we're talking about things like Form W-2, Form 1099, or Schedule K-1s, that sort of thing. Those are information returns that are subject to this mandate that was in the Taxpayer First Act. Part of the Taxpayer First Act was that the IRS was supposed to issue regulations that would reduce the aggregate number of information returns that would trigger a mandatory EFile requirement. So for a very long time, the EFile requirement has been 250. So if you had, for example, a corporation that filed 250 information returns, like you have a large corporation and the corporation files forms W-2, they file form 1099, and if they file 250 or more information returns like that, then the corporation itself is required to e-file the corporate tax return. The Taxpayer First Act was supposed to lower that threshold from 250 to 100 returns in 2022, and then down to 10 returns for years after 2022. So we were already supposed to have a much lower e-file mandate threshold for most businesses. But the IRS has been really slow getting this guidance out, getting these regulations out. And, to be honest, they've been really busy, right? It's been a kind of a crazy couple of years. So they haven't gotten these regulations out. Proposed regulations were released on July 21st, 2021, but no additional guidance from the IRS was forthcoming. So as of today, for the 2021 tax year, the e-file requirement for most businesses is still 250. So that's the threshold for the information return requirement. If you have a corporation or a partnership that files 250 information returns or more, then they're required, the business itself is required to e-file their tax return. And we're going to talk more about the e-file mandates that apply to businesses because partnerships also have their own e-file mandate that's based on the number of partners that the partnership has. So you need to know those for the test. I'm just telling you right now. But this e-file mandate that was in the Taxpayer First Act has been stalled. The IRS hasn't managed to get the guidance out. So there's just proposed regs and proposed regulations. IRS regulations, we're going to go over this in part 3. But IRS regulations go through like a 3-step process. So it's proposed regulations first, and that's the IRS requests commentary from the public, usually, the AICPA and the NAEA, and, individual accountants will comment on the regulations. So we're still in that stage. We're still, the regulations are still just proposed. And then from there, we go to temporary regulations, which are valid for 3 years. And then we go to final regulations. That's an ideal scenario, right? Because sometimes the IRS never finalizes their regulations. But as of right now, in 2022, for the 2021 filing season, the threshold is still 250. So we just have the proposed regs and the guidance hasn't been finalized here. Regardless of what you read online, that's how it is right now. Right? We're in a holding pattern. We're waiting for guidance. Form 1024A. So this is an application for nonprofit exemption. This is for exempt entities that are not 501c3s. So the Form 1024A is used for organizations seeking to be exempt under Section 501c4. So these are not charities, but they are nonprofit groups, and we have a whole webinar that's just dedicated to nonprofits. But the application for Section 501c4s is now available online through pay.gov. It's supposed to be a lot easier to do it this way, but the IRS is not accepting paper applications anymore. So these used to be sent in on paper, and now you have to submit them electronically through pay.gov. And there's a user fee. It's not free. So the required user fee for Form 1024 is $600 in 2021. 501c3s file a different form to request formal exemption. They file Form 1023, and they've had to submit that form online since last year. So that was one of the changes that was also put into effect by the Taxpayer First Act, but that change actually did go into effect. If it's a 501c3, they also have to submit their application for exemption online on pay.gov, but it's a different form. It's Form 1023. And then the Form 1024A is for Section 501c4s. And we're going to talk about all these types of exempt entities when we go into the exempt entities webinar. All right, that's the end. The next unit is going to be Unit 1, which covers business entities and requirements.